Hi, it's Richard Hemming and Under the Radar Report. It's great to be with you. I'm here to discuss whether small caps can outperform big caps. So obviously, small caps have the power to outperform big caps. That's why growth investors like me love them. But what's the evidence? What's the evidence they can do it? Putting it simply, small caps will always beat the market when you pick the right ones because they can go up tenfold or more. Like, this is something your blue chips simply cannot do because they are the market. So that's why small caps can beat large caps. But underpinning our faith are the three big investment lessons of the past 50 years, plus the experience of our own small cap dividend portfolios. So what's the first big lesson? The big lesson of the past 50 years has been the power of diversification to reduce risk. So simply by owning 15 to 20 stocks, you reduce the individual risks within each stock because they offset each other. So basically the result is you get more consistency of returns. So while a stock can move, can gyrate quite, wildly, the overall return of your portfolio will be much more stable. That's as long as you populate it with the right stocks. But this is the big investment lesson. So the second investment lesson is that we've learned in the past 20 years the power of ETFs, specifically the power of index-linked ETFs. The fund flow has been phenomenal. This has pushed momentum investing to the fore. So basically, these ETFs, they don't invest on a basis of, a stock's profitability. They don't invest on the basis of fundamentals. They simply invest on the basis of what weighting a stock has in the index. And then that is powered by fund flows. So a classic example has been CBA. In the past few years, CBA has almost doubled from being under $100 to being just under $200. It's gone from a P of 15 times to a P of 30 times. Other stocks, JV Hi-Fi, these are stocks that increase their dominance in the index because of their size and their growth. So basically, you've got to remember that the stocks in the index-linked ETFs are the market. So owning just one big performing small cap will always beat these lumbering giants because you're getting an averaging effect in the ETFs. So which are these stocks? Well, there's a number of them that have improved 8-10-fold in the past decade. Like, you'll know them. Ones like, you'll know Afterpay, you'll know Northern Star, you'll know Gentrack, you'll know Evolution Mining, you'll know Nick Scali, you'll know Austell. The list goes on. You need to pick just one of these stocks to transform your returns. And you will pick them, but you need to pick a few of them to get one. So the third investment lesson is dividends. So dividends is the special quality that the ASX has. Why? Because you get the imputation credits, you get the tax advantages of owning dividends. This boosts your overall return in excess of just a yield. So you're getting a lot more bang for your buck with your average ASX related dividend. So how do you take advantage of all this? Well, let's get into it. Let's talk about diversification first. Basically, you need to own at least 12 stocks. Like, that's been our experience because the rewards are there. So we release 100% small cap dividend portfolio every 6 months. Every 6 months. So we've got like 16 or 17 of them. So this has been our experience. Most recent dividend portfolios were released have returned about 20% a year. What's the market done? 6 to 7% a year. But like, of the 16, 17 portfolios we've done, the average return is still good at 15% a year versus the average return of the All Ords around 6% a year. So what we're seeing is that our performance is actually improved over time, partly because we've included, rather than 10 to 12 stocks, 12 to 14. So let's drill down further. What is going on at the small cap level? Oh, I've got two words for you: operating leverage. So off the small equity base, these stocks, these companies have superior return on equity. And what happens when that return on equity gets compounded? You get supercharged returns, as long as you're paying the right price. But honestly, patience is the main game here. So let's go through an example. Why does patience work? Well, what comes into it is what I call 3 bites of the cherry. Very catchy, I know, but it's real. What's the first bite? The first bite is a survival boost. Let's look at Gentrack. That's a good example, because when we bought Gentrack 3 years ago, 2 or 3 years ago, it was like $1, $1.30 or something like that. It was unprofitable. What happened then was it proved it could be profitable. So you get your first bite, you get that survival boost. Then what happens? What's the second bite? Well, then they prove that they can maintain that profitability. The market thinks, well, we want to capitalize those profits into the future. We're going to buy this stock. So then you get the second bite. So what's the third bite? The third bite is when you get airlifted into the index. So basically, they get that profitability growth. They improve their profitability. Investors want it. It's like a virtuous circle. So then it gets bigger and bigger, and then it gets airlifted into the ASX 300 index. That's where you get the power of the ETFs coming in. That's where you get a supercharged effect. But look, that does not always happen. It doesn't always happen. But what happens more often than not in the small cap world is takeovers. Takeovers happen in 1 in 5 situations of the stocks that we've ticked. So that's 1 in 5. In our dividend portfolio, that's increased to 1 in 4 times. So that is basically what a lot of these corporates are looking for. They're looking for profitability. And guess who produces that profitability? Companies that have a track record of paying dividends. Only last week, Infomedia got taken over. So this is a normal occurrence for us. It ebbs and flows, but it's consistent over time. Companies, corporates, investors cannot get enough of dividend-paying small caps. So this brings me back to the third pillar of dividends, why they really matter. Because on their own, a dividend will not make a difference, will not make a big difference to you. But what it does is it provides a sign of profitability. It provides a sign for corporates to say, oh no, I know this stock can add value to our company. Basically, these dividend portfolios, they perform consistently over time. What we've seen is that occasionally they get taken out, but occasionally they get put into an index. But you only need 1 or 2 stocks in each of those portfolios to make a difference. You only need an Ostor, a Nick Scali. These stocks were included in our dividend portfolios, and look at the portfolios now. Look, I'm not saying that blue chips don't have a place. These companies are called blue chips for a reason. They have market dominance. So hence they have more ability to pay dividends. But you might remember COVID. Well, that 100% certainty of paying dividends, that was a fallacy. That did not happen. So there is risk. But because you're paying up so much for these blue chips, you're not getting rewarded. You're not getting the expected value. On the other hand, there are occasions where small isn't always beautiful, and I would say mining is a classic case. That's why in some of our small cap portfolios, we include single commodity mining stocks. These stocks often produce dividends, but they also produce growth potential. So look at Northern Star, look at Evolution Mining. So it's no accident that both these companies and many others have been founder-led. So that's another point you've got to factor in small caps. There's nothing like skin in the game to generate success. That's another reason why some of these dividend portfolios have done so well. So let's sum up. The combination of diversification and stock picking allows you to do something very special. You can buy a bunch of stocks that don't have much in common. In this case, ones that are forecast to pay dividends, and boom, you're getting much more than 5 or 6% a year return. You're getting double digit or more return. So the combined effect is that you're actually reducing your risk, but you're increasing your probability of getting a Northern Star, of getting an Evolution, of getting a Nick Scali. All the while, you're getting tax-effective dividends. So under the radar isn't just an avenue for picking stocks. What we're doing is working out risk profiles of companies. We're consistently mixing them together into portfolios. Anyone can invest in an ETF. Anyone can invest in a fund, and that has its place. But if you want life-changing returns, small caps are a fantastic and fulfilling way to invest. I won't deny it. There's easier ways. You can just put your money into a fund, put your money into an ETF, but you're not going to get the kind of rewards you can get from investing by yourself in small caps. They got me genuinely excited when I was in my 20s, and nothing has changed. It continually excites me. So we hope it can work for you. Remember, you only need one of these big returning stocks to make a life-changing difference. And we help you find that stock. That's all we do. So in summary, let's talk about what we're doing. We're harnessing diversification. We're harnessing the ETF-generated market momentum. We're harnessing dividends. We're delivering consistent above-market returns. We do this year out in small caps. We do this in our dividend portfolios, in our best buys. This is something your blue chips simply cannot do because they are the market. This is why small caps beat large caps. Our next dividend report will be in September. Sign up now to make sure you get exclusive first dibs to our profit-making dividend-paying small cap portfolios. Well, if you're looking to invest on the ASX, if you're looking for growth, if you're looking for income, you're in the right place. Our team has been investing for 40 years. 40 years. 14 of them we've been at Under the Radar report. How many stocks have we tipped? Over 400. Average return, 78%. That's right, 78%. This channel gives you access to insights we share with thousands of private clients, with loads of fund managers. This channel gives you the ability to make money on the ASX. So whether you're after stocks you've never heard of, whether you want access to our dividend portfolios, which by the way have shot the lights out, check out our cash and growth returns in our dividend reports, or whether you want our blue chip report, which gives you blue chip analysis plus economic analysis delivered quickly and simply. Or you can read our step-by-step guide to building wealth. It's all here and we break it down. Look, we put you on whichever path you're going to be comfortable with because investing is so personal. Our secret sauce is finding stocks that are right for you. We have a risk rating. We have a portfolio rating. We have a radar rating. All these ratings mean that you are equipped to build and manage your own portfolio. In our research offering, you'll find stock recommendations. You'll find expert commentary. You'll find market updates, dividend strategies, a portfolio builder course, and more. Subscribe now to get ASX insights that cut through the noise, that put you in control of your financial future. Because in the stock market, it pays to be under the radar.